Hey everybody, this is Rob. I'm a real estate investor and a realtor, and I'm going to talk about how you can use inflation to make money using real estate. All right, let's get into it. In the first part of this video, I'm going to explain the concept and how it works. In the second part, I'm going to show you what I've been doing and how it's worked for me. And then in the third part of this video, I'm going to talk about what you can do to make this happen for yourself. So part one, understanding how to make money from real estate and inflation together. And the big thing that has to come into play here is that real estate is a leveraged investment. So over time, real estate tracks inflation. So real estate prices don't go way up or way down, and that makes sense because people's wages kind of track inflation and they can only afford so much house. So real estate prices over time, over the long term, tend to track inflation. So we're going to make that assumption. Let's say we start out with a $300,000 house. All right, so I chose 300K because it's about the median price of a house in the US. All right, so warning, we're going to get into some math. We're going to look at spreadsheets. We're going to look at compound interest, all that good stuff. Just, I don't know. I'm an engineer. I'm a nerd. So nerd alert. This isn't a fluff piece, it's actual numbers. So let's start off talking about the base case where you have $300,000 house and you're putting 20% down and you got $10,000 in closing costs. So for me, that means you need $70,000 in cash to do this basic example. All right, I know not everybody's going to have $70,000 in cash, and I'm going to show you at the third part of this video how to do it with a lot less in cash because of the way that the government structures first-time home buying programs or just buying your own personal residence. Let's also assume that you're paying right now $1,600 a month in rent, which I think is about average for a lot of people if you're going to look at a house about that size. So let's assume 8% inflation over the next 5 years for this example. Inflation could be higher, could be lower. That's obviously up to you to decide. Again, I'm just using it for an example. All right, so we got $70,000 in cash. Let's say we hold it in cash. It goes from $70,000 to worth $48,000 in today's dollars. If we look at the rent with the inflation, rent is going to go up to $23.50. But again, it's actually going to be the same in today's dollars, but you're actually going to be paying this. So hopefully you can get 8% raises on your income every year. And I know that's going to be tough. Inflation really squeezes people that have wage-based income. And that's really something you've got to watch out for and be ready for. All right, so we said, hey, we're getting an 8% loss each year and my expenses are going up and hopefully I could still afford to rent my place when inflation happens. So next we're going to talk about a better scenario, which is investing in the stock market. And we look at inflation at 8%, and let's just say the stock market returns 5% above inflation, which historically is about the average. Here we can see we're going from 70 to 129,000. The return over 5 years is 184%, averaging 37% over 5 years. But really, in fundamental dollars, it's a 5% return on your money year over year. So if we look at that in real dollars, you're 71 to $89 in today's dollars. Okay, but it looks like 129 because of inflation. All right, so your returns are, 5% a year. Not bad. All right, so let's go to our example, buying a $300,000 house. So we put the 70 down. We've got 300. Next year it's worth 324, 350, 378, 408, 441. Our loan balance is going to decrease $5,000 a year, and our delta is going to be this here, which is the difference between the value of the house and the loan. So we see now that delta rises to $226,000 on $70,000, giving a total return of 323%, averaging 65% over 5 years. So that is twice as good as the stock market. So it's why having a leveraged investment with low interest rates is great in an inflationary environment. And in the US, you can lock in a fixed interest rate, which is a huge deal because, interest rates right now are around 3%. So if you got 8% and 5%, you're making the spread on a large amount of borrowed money. All right, so let's talk about what I did. And my journey starts a long time ago. I got debt-free using the Dave Ramsey plan. My wife got debt-free. We got married, cash flowed a wedding, and then we saved $100,000, which I know is a lot for a lot of people, but hey, that's just what I did, and it took a couple years. In January of 2020, we closed on our first house. We did a live-in flip on that house, and then he locked out and bought a house in Florida. So let me dig into the numbers on that with you. All right, so here we're getting a little personal on what we did. So in January 2020, we bought a house for $397,500. We put 15% down, which was $60K. I'm a realtor. I got my own commission, so that covered my closing costs for me. But you could do a similar thing with an assist if you're buying a house. I then proceeded to renovate this house, and I ripped it all apart and put it all back together, which you can check out in one of my other videos. There's a whole series on it called Flipping Westchester. But anyway, if you want to check that out, you can. It ended up costing about $45,000 and a lot of sweat equity, but I did it. So anyway, we invested $105,000, and then we decided we wanted to buy an investment in Florida. So we appraised the house at $540,000 by the bank late winter, and then we got a HELOC for $100K. So this means I BRR'd my house. And if you're not familiar with BRRRR, I got some videos on that as well, but basically that means I pulled all the cash out that I put in. Next, we bought a rental in Florida for $338K. We got a $260 loan and a $95 HELOC. If you're saying, hey, that doesn't add up, well, there's closing costs involved, and we had to buy stuff and furniture and fix it up and this and that. So we're in for that. I would say the current value of our house now is $595, and the current value of the rental is $360, and that takes the total real estate value to $955. Our current loans are at $683,000, making for the delta at $272,000. Now this is in 1 year, pretty much like a year and 4 months. So we turned $100,000 in 272. Obviously, it's like 165% return in 1 year, which is fantastic. And that has to do with me understanding real estate investing and making some fundamental decisions there. So if you can combine understanding real estate investing with inflation, the power even multiplies faster. My total payments on both properties are $4,750, and I'm pulling about $4,500 a month in rent on the rental in Florida. However, I would say there's some vacancy in there, so we'll say around $4,000. So my total monthly payment on almost $1 million in real estate is around $750, which is just awesome. You know, you might say this is impossible, but it's what I just did. So if I can do it, you can do it, and I can help show you how. All right, so let's talk about what happens now over the next 5 years in my situation. So I'm currently at $955. If we inflate at 8% per year, that puts my holdings at $1.4 million after 5 years. My loan balance paying down about $12,000 per year on all the loans. That puts me at $623 with a delta of $780, putting my total return at 743% and averaging over 5 years at 150% per year, which is great. You can see I'm getting a little more of a bump in the beginning because of the live-in flip that we did, and you know, there's some definite tax advantage to that. Now, of course, if I've got $780,000 of equity sitting in the bank, I am not going to let that sit there, because that's almost a 50% ratio here. Pull out about $500,000 here and buy additional property, and I'll obviously do that later next year or sometime sooner than that. So you can really start compounding this again if I'm going to buy more and more real estate. All right, so let's get into how you can do this with much less money than I had and how your returns can actually be even bigger than mine. So I can share what I know and help you. All right, let's look into that example. So let's talk about average person here buying the average house at, again, $300,000. We're going to do an initial investment of $10,000 because we're going to do a low money down loan, maybe a 3% down, maybe a 5% down loan. And in Pennsylvania, I'm counting this as using the K-Fit program, which I have another video on, which gives you 5%. So let's say you have $10,000, just roughly, because if you use the K-Fit, that's probably about the average between. Your payment's going to be a bit higher because you're leveraging more money here, and you're going to have mortgage insurance and that kind of thing. All right, so again, we start at $300. Our loan balance is going to be about $290. And we can see, we're going to have the same basic decrease, $5,000 a year. And at the end of year 5, we have $176,000 in equity from our $10,000. So this is a 1,406% return, averaging 281% over 5 years. I think this really helps to explain why the average homeowner has 40 times more wealth than the average renter. If you're playing the rental game, you're fighting against inflation and swimming against the current. Inflation's going to happen. The U.S. government's going to do it. It's going to be higher than it has been for now because that's the way the government is exiting their debt. I think we can all see that happening around us if we open our eyes to that. Okay, now you may say, Rob, what if real estate prices crash? Or what if they raise interest rates? I think if they raise interest rates, that will slow the price growth in real estate, which is why I'm accounting for some slowing in growth. However, I don't think they can raise interest rates too high because it really will stall the economy. So they're kind of going to let inflation run a little bit is my thought. The other thing is, in terms of a housing crash, I don't think one is coming right now because of the fundamentals of the market in terms of supply and demand. After 2008, they underbuilt houses by a large amount. So that really has to come into play here when you're thinking about this stuff. Now, could that crash happen? Sure. I don't know, right? But a recovery almost always follows that. Even 2008, we've recovered now. And, obviously, if you bought the absolute peak, it took you a long time to recover. But you eventually will recover. And over the long term, real estate prices will track inflation. Okay, so we kind of went through an example of how you could do this for yourself and how you can make this happen, and I can help you as well. I can get you connected with a real estate agent in your area that understands real estate investing, and you could start with buying a personal residence if you haven't done that already. Awesome opportunity for a house hack if you're a young person that maybe can rent out a room or two, or maybe do a multifamily. There's a lot of ways to do this. It's really, honestly, there's a lot of depth here. So, subscribe to my channel. You'll see more and more information about how to do these things. But yeah, I can get you connected to someone in your area if you'd like and get you started. You can kind of see how this could snowball for you and really help you build a lot of wealth through real estate, which is the mission of my channel and what I'm doing with my practice. All right, everybody, have a great day.